Solutions to Assignment 1, Part 1. We're dealing with financial statements. We're going to divide these solutions into two parts. DeWitt Manufacturing Incorporated has the balance sheet amount shown below. DeWitt is financed only with debt and common equity with no preferred stock. And we're simply given a jumbled listings here of cash and cash equivalents. You can read the amounts on the right. Retained earnings, accounts receivable, accounts payable, notes payable, long-term debt, inventories, net fixed assets, and paid-in capital. So we need to arrange these to provide a standard balance sheet. That's what we're asked to do in Part A. We start with assets. And you start with the current assets. The current assets would be the cash and equivalents, accounts receivable, and inventory. I list them in that order because cash is the most liquid, accounts receivable next most liquid, inventory the least liquid. Gives us total current assets of $500,000. We're given net fixed assets of $1.8 million. That gives us total assets of $2,300,000. Okay, now we need to make sure when we do the liabilities and equity that we get total liabilities and total equity of $2.3 million. So we need to check that at the end. We start with current liabilities. Well, we were given two current liabilities accounts payable, notes payable, and they sum to $350,000. We then add the long-term liabilities, which is long-term debt, $550,000, and we get total liabilities of $900,000. Okay, now we move on to equity. We're given two components of equity. First, we have paid-in capital, 50,000 shares of common stock, $500,000. That means the firm has issued 50,000 shares. If it was just a one-time issue, obviously they got $10 a share when they issued it, and that amount stays on the balance sheet at that amount. The equity grows by retained earnings. When a firm generates net income, remember at the bottom of the income statement, net income is after everyone has been paid. All the suppliers, interest expense for bondholders, taxes, what's left belongs to the shareholders. But that doesn't mean that whatever net income is for a given year, that's going to be paid as a dividend. If it's not paid as a dividend, that's additional equity investment by those shareholders. Those earnings that are being retained are being invested up here into the assets. Probably most of that has been invested in increasing the net fixed assets of the firm. Most of it. It would be reasonable that some of it is, in the current asset section as well. But it's additional equity investment by taking money that could have been paid to the shareholders and instead was reinvested. So we get total common equity of $1.4 million, and therefore total liabilities and total equity $2.3 million. The 1.4 gets added to the $900,000 of total liabilities. That gives us $2.3 million, and of course we find that it balances with the total assets. Part B, what is the firm's net working capital? What is the firm's net operating working capital? Well, you should recall from your accounting that net working capital is current assets minus current liabilities. It's a very straightforward calculation. Formula anyone in finance or accounting should know. Current assets were $500,000 from the previous statement. Current liabilities are $350,000. Therefore, net working capital is $150,000. Net operating working capital, as the name suggests, only includes items in the current assets and current liabilities that are caused by operating activities. Well, your current liabilities, which is going to consist of accounts payable and notes payable, the accounts payable gets generated kind of spontaneously, if you will, through a firm's operating cycle. Part of that operating cycle is to receive raw materials that are used in the production process, but they don't pay for those raw materials immediately. They may have 30, 60 days to pay for that. So they're generating accounts payable. And again, that accounts payable is total into current liabilities. But notes payable is a decision to go to the bank and take out a loan. It doesn't arise naturally or spontaneously, if you will, from the operating decision, operating activities. So we subtract it from the current liabilities. So now our net operating working capital, again, current assets is $500,000. From the total of current liabilities, we subtract the notes payable of $150,000, and we're given a net operating working capital of $300,000. We're going to use this NOWC, net operating working capital, later when we calculate the free cash flow for a firm. Number 2, Dustin Metals Incorporated has the following income statement amounts. Interest expense, $85,000, depreciation, $140,000, operating expense, which excludes depreciation, $230,000, and then sales of $725,000. Construct the income statement for Dustin Metals. We're going to assume a 35% tax rate. All right, we start with the sales at $725,000, subtract the operating expense and the depreciation, and that gives us EBIT, earnings before interest and taxes, of $355,000. We subtract the interest expense of $85,000, and that gives us EBT, earnings before tax, of $270,000. We weren't given the tax amount, but since we know the tax rate of 35%, we multiply EBT by 0.35, and we find that taxes are $94,500. We subtract that from EBT, and we get net income of $175,500. Assume Dustin Metals had 20,000 shares of common stock outstanding during the year. What is the earnings per share, EPS? Well, earnings per share is net income. I simply write number of shares. Technically, it's the weighted average number of shares outstanding during the year. But we don't have any information that would allow us to compute a weighted average, so we assume that 20,000 is the weighted average. You know, keep in mind, a firm's number of shares can be changing throughout the year. It could issue new shares, they could have exercise of warrants or stock options, or they could repurchase stock, but we're going to ignore that. We're simply going to use the 20,000 shares, take the net income over 20,000, earnings per share $8.78. Number 3. Branston Cooper Incorporated recently reported EBIT of $12.5 million and net income of $6 million. The firm's tax rate was 40%. What was the interest expense? Okay, this little table kind of summarizes what we're given and what we need to figure out. We're given EBIT of $12.5 million. We're given net income of $6 million. We need to determine interest expense. We're not going to be able to get it by starting with EBIT. There's just nothing in this problem that allows us to go directly from EBIT. We've got to start at the bottom with the net income and work backwards up the income statement. Because we know the tax rate, we're going to be able to do that. Okay, how do we do that? I'm going to do a little derivation for you. We'll just do it once, and then in the future, I would recommend memorizing the very simple result we're going to have, a little equation, and we'll just use that equation as a shortcut moving forward. But let's derive it for the first time. Very simply, net income is EBT minus taxes, right? That's how we get net income. We take EBT and we subtract taxes. I've simply written that there. Now, taxes is simply the tax rate, T is the firm's tax rate, 40%, times EBT. So I simply write taxes as T times EBT. And I'm going to substitute T times EBT for the taxes in this equation here. And that's what I now have. I have EBT minus taxes, where taxes is T times EBT, is net income. And now, in these first two terms, I have an EBT common in both terms. So I'm going to factor it out, and I have EBT times 1 minus T is equal to net income. And now I can divide both sides by 1 minus T to determine that EBT is net income over 1 minus T. And we can now apply that in this situation because Branston Cooper had a net income of $6 million. If we divide that by 1 minus the firm's tax rate, we see that EBT must have been $10 million. So I now put that into my previous rectangle that I had with the missing amounts. I now know EBT is $10 million. We weren't asked to do it, but I went ahead and filled it into $4 million. It must have been $4 million in taxes. And we can see 10 minus 4 is $6 million. Well, if EBT is $10 million, EBIT was $12.5 million, interest expense obviously must have been $2.5 million. Number 4. Peabody Marine Incorporated reported EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization of $150 million, interest expense of $40 million, and net income of $36 million. Its tax rate was 40%. What was its depreciation expense? Well, very similar problem. But instead of starting with EBIT, we're starting with EBITDA. But EBITDA of $150 million had depreciation subtracted to get EBIT, from which we subtract $40,000 to get EBT. 40% of that gave us taxes and resulted in $36 million. But it should be pretty clear we got to do the same process of working backwards up the income statement if we want to figure out depreciation. Well, we know how to compute EBT. We take the net income of $36 million. We divide by 1 minus T, where T is 0.4. We're given a 40% tax rate. So EBT must have been $60 million. Let's fill that in. EBT is $60 million. Again, I put the tax in. Didn't need to do that. $24 million gives me net income of $36 million. Well, if EBT is $60 million and interest expense was $40 million, EBIT must have been what? $100 million, of course. And therefore, if EBIT is $100 million and EBITDA is $150 million, depreciation must have been $50 million. So these are very simple problems as long as you remember to take net income divided by 1 minus t to get the EBT, and then you simply start adding back what was subtracted. Number 5. In its recent financial statements, Bellamy Incorporated reported $160 million of net income and $960 million of retained earnings. The previous year's retained earnings were $860 million. And we should see from this immediately that retained earnings increased by $100 million. That's going to be important. Compute the dividends paid to shareholders during the year. Well, one of the fundamental accounting relationships is that the change in retained earnings from one year to the next is the net income for the current year generated minus the dividends paid in the current year. If we know net income during the current year and we know the dividends paid during the current year, we know the change in retained earnings from the previous year to the current year. Well, in this case, we know the changes in retained earnings. It went from 860 to 960, therefore the change in retained earnings is $100 million. Net income was $160 million, so I think it's pretty clear that the dividends paid must have been $60 million. Number 6. MX Foods reported $325 million of total stockholders' equity on its most recent balance sheet. The firm has 20 million shares of common stock outstanding that sell at a price of $30 a share and no preferred stock. What is the market value added, MVA, for MX Foods? Well, market value added is the market value of equity minus the book value of equity. Book value of equity is what's on the balance sheet. It's going to be the paid-in capital and retained earnings. You subtract off any treasury stock that the firm has repurchased shares of common stock. But it's basically what has been contributed by the shareholders, less what's been repurchased. And the market value of equity is what that equity is now worth on a stock exchange. What investors are willing to pay for that share, for those shares of stock times the number of shares. Clearly, you want the firm's managers for their actions, activities, to generate a market value of equity that exceeds what's been invested by the shareholders. That's what we call it market value added, above and beyond what's been contributed, which is book value of equity. Now, market value of equity is simply the number of shares outstanding times the current price per share, and that's going to fluctuate. It can fluctuate, every 5-10 seconds for an actively traded common stock. We subtract the book value of equity from that. We were given 20 million shares at $30 a share. We were given the book value of $325 million. That's what's on the balance sheet. That gives us $600 million of market value of equity, $325 million book value of equity, for a market value added of $275 million. Number 7. On its most recent balance sheet, Hinton Corp reported $324.5 million of retained earnings. Hinton's only issuance of common stock resulted in 12 million shares being sold at a price of $15 a share. That's 12 million shares of common stock. Hinton's common stock is currently selling at a price of $50 a share. What is the firm's market value added? Okay, in order to do the market value added from the previous formula, we need market value of equity and book value of equity, right? Well, let's start calculating book value of equity. The book value of equity is the paid-in capital plus the retained earnings, as we've discussed before. The paid-in capital, $180 million, is the 12 million shares that were issued at a price of $15 a share. That's the 180 million. 12 million shares, $15 a share. Shareholders have provided $180 million of equity capital to the firm. The firm has reinvested $324.5 million in net income. That's the retained earnings. That's additional equity contribution, kind of an indirect contribution, if you will. This would be the direct contribution. This is money that could have been paid as dividends that it wasn't, but instead reinvested. The total book value of equity on the firm's balance sheet would be $504.5 million. The market value of equity, again, is simply the number of shares outstanding times price per share. There's 12 million shares, $50 a share, $600 million. Therefore, market value of equity, market value added is market value of equity minus book value of equity, 600 million market value of equity, 504.5 book value of equity, market value added $95.5 million. Number 8. Randstad Energy Corp reported $460 million of net fixed assets on its 2012 balance sheet. If Randstad reports $38.5 million of depreciation expense on its 2013 income statement, and its capital spending for 2013 was $46.2 million, what amount of net fixed assets will Randstad report on its 2013 balance sheet? Okay, so the goal here is to take net fixed assets in 2012 and to determine net fixed assets of 2013. Well, how did net fixed assets change? They change in two ways. It's reduced by additional depreciation taken on the income statement in 2013, and that was $38,500. You can see I'm subtracting it. And then it's increased by any additional capital spending. Capital spending is investment in new fixed assets, $46.2 million. Therefore, the net fixed assets of 2013 is $467.7 million. Number 9. Diamondx Corp issued 10,000 shares of common stock. It was an IPO, initial public offering, the first time they ever issued stock. So it was a new company at that point with publicly traded shares of stock. 3 years ago, the price was $8 a share. So 10,000 issued 3 years ago, $8 a share. But then a year later, they issued another 10,000 shares at $30 a share. Clearly, they've been doing something good if the price went from 8 to 30. No other stock issues. Just those two. So you're going to have, 20,000 shares now. The total net income reported on the firm's income statement over the past 3 years, if we simply look at the last 3 income statements and add the net income, $729,000. Diamondx paid no dividends during the first 2 years, but paid a $2.50 per share dividend last year to its common shareholders. The firm has not repurchased any shares of common stock. What is the book value of equity that Diamondx reported on its most recent balance sheet? Okay. Well, we need to determine the paid-in capital. I write common stock here. You'll see that sometimes. If you like and you're taking notes on this, I would actually write paid-in capital. I think I use that more commonly in the materials that we're dealing with. Well, the paid-in capital, there's been 2 issues of stock. 10,000 shares at $8 a share, 10,000 shares at $30 a share. The firm has received direct equity contributions paid in capital of $380,000 from shareholders. The retained earnings is the sum of all the net income, which is $709,000 that was given, minus any dividends paid over the last 3 years. Now, this becomes easy because the first year they didn't pay any dividends. They only paid a dividend in the 3rd year, and by the 3rd year they had 20,000 shares. 10,000 3 years ago, 10,000 2 years ago. By the 3rd year they had 20,000. They paid a $2.50 dividend. So they paid a $50,000 dividend. Subtract that from $729,000 and retained earnings is $679,000. Well, the balance sheet is going to have paid capital, 20,000 shares, $380,000. Retained earnings is $679,000. Total common equity, $1,059,000. Okay? And this ends our part 1 of Solutions to Assignment 1.